Hello and welcome to the MoneyMagpie Invest podcast. I'm Jasmine Birtles, founder of MoneyMagpie.com. And before we do anything else, have you followed us? Have you subscribed? And do remember that we do love it when you comment on these videos because it's very interesting to hear what you have to say. And I do read them all and I do reply to them. So make sure you comment as well. Because today we have somebody very interesting. We have my friend Bob Lyddon, who is a management consultant in banking and financial institutions. And Bob has written a number of articles for various outlets, Global Britain and his own website, for example, all about the EU and the financial and economic problems that the EU is having. So, Bob, welcome to you.
Welcome. Thank you. Thank you, Jasmine.
So, Bob, I know that you have been a Brexiteer from the start. You actually campaigned for Brexit. Why? What was it about the EU? What is it about the EU that you have felt has been so toxic that the UK should not be part of it?
Yes. Well, I felt that the EU would suck the UK into the euro. The fact we haven't got the euro is fine. We're like on level three. So the ones in level one have got the euro. Then you've got Sweden and Denmark, who, to all intents and purposes, have the euro. And then there's all the others who have some kind of obligation to join. Um, and the euro is not a free market. It's a highly expensive market where prices are propped up to the benefit of suppliers by things like high regulatory technical standards. So when Donald Trump says it's a protectionist regime, it is. It's kind of free once you're in it. And if you control the definition of all these standards and rules, then it's free. It's fantastic because you've got a protected captive market, but it's not free trade in any realistic sense. And because it's regulatory and rules driven, it's state directed. And if over the long term, the state's priorities, the EU's priorities, will determine where resources are allocated. And that's not a free market either. And eventually it will run itself into the sand. That's what's happening. It's stagnated. It's inward looking, stagnated, and drowning in debt.
Well,
And
mind
I
you,
didn't think we wanted to be part of that.
no, well, very true. I think the way you describe it is something, as you say, who would want to be part of that? But then you could say the same for the UK, stagnating, it very much so, and being drawn into the sand. So, is there any difference from the way we are outside of the EU to inside of it?
Well, it's got worse since Labour came to power because they are rejoins. They're all pro EU. They see the EU as some kind of a Garden of Eden. But it wasn't even very good after the Brexit vote, where Theresa May was a Remainer and rejoiner. Rishi Sunak was effectively a Remainer. He thought he was a Brexiteer, but he wasn't, because if he was a Brexiteer, he wouldn't have rejoined programs like Horizon Europe, the scientific program. He'd have said, no, we've done Brexit, we're out. We're not joining any of your programs. They wouldn't have signed the Northern Ireland Protocol. They wouldn't have gone in for the Windsor Framework that tied us in, basically continue to tie us in, because we've never had a proper Brexit government. And when you had Boris Johnson, who pretended, again, for his own reasons to be a Brexiteer, he's a high spending, central government person and just is into big projects, big spending, state directed. So in reality, he was an EU person as well. We've never had a Brexit government. This is what's so frustrating, that all this stuff about we got Brexit done. Yeah, legally, maybe there's a contract that we're not paying into the budgeting, that we're not responsible for some of these debts. But in terms of overall financial and economic management, it's still completely run on EU lines. It's not helped by the civil service, who can't think for themselves.
Well, true. And So essentially, we are still in many ways connected with the EU, which
Mm.
if your analysis of where the EU is, particularly the euro, but the EU generally that's not good news for us because your analysis is that the EU is on its way out, essentially. I mean, it's on its way towards collapse.
Well, I think it's an outdated administrative and bureaucratic process or set of processes that have maybe worked for the 1950s and 60s, maybe the 70s, but have become increasingly unable to change gear as the world changes gear. And we decided, I mean, the biggest benefit of Brexit so far, tangible, is joining this Trans-Pacific trading partnership. But that's brilliant. We would never have been able to do that if we'd remained in the EU. And then the next thing on the table is a better trading relationship with the US. And what do we see? We see our negotiators, the same people, Ollie Robbins, back in the seat, giving away our, our potential benefits. For what? To get this closer reset. This is absolutely ridiculous. But I really believe that Keir Starmer doesn't understand, because why would he? He's never run a business or an economy or anything. That he doesn't understand that a reset with the EU adopting, say, EU medical or veterinary standards precludes a free trade agreement with the US. Somehow he thinks they're both possible, aren't. And which would you go for? A stagnating, highly indebted economy like the EU or the US, the biggest economy in the world? Well, it's a no-brainer, really. You go with the US because it fits with the Pacific Partnership Agreement and other deals we're doing. But you can't rely on that because Starmer is a rejoiner, a
So,
remainer rejoiner surrounded by rejoiners.
and you're saying, understandably, that the EU is a stagnating, sort of indebted entity. Can you explain a bit more? Can you describe how that is, how it's happened, and what it is that you're describing? What is it
Yes,
about?
I think it's in a way, it's almost like Louis XIV. It's the concept that the state, because it's the state, is enlightened. It knows better than the private sector, particularly as how to direct economic resources. So after the euro, specifically after the euro sovereign debt crisis 2011 to 2013, the EU designed two or three schemes to get more money to spend. So the main one is called InvestEU, and it's mainly directed towards green energy, but it is just off balance sheet. It's very like private finance initiative, PFI here. So it's borrowing off balance sheet, so not visible in national debt, to build these plants, whatever it is, to produce rather expensive green energy. But when you build the thing, the spending of the money increases GDP. So it's a statistical increase in GDP now, but over time, the increase in the high cost electricity is a drain of GDP. So it's a quick sugar rush of GDP growth now for a hangover in the future, just as PFI has been, just as Ed Miliband's schemes will be, because Ed Miliband's schemes are designed around PFI and InvestEU. But this is trillions of euro in the EU. And to add to that, you have the response to the pandemic, which was called Next Generation EU, or previously the Coronavirus Recovery Plan, which is borrowing 750 billion euro, giving half of it out in grants. Okay, that's fine. The EU's borrowed it, given it out in grants. How does the EU repay its own debts? Well, with extra taxes on EU member states. So it's a sugar rush in the short term and a nasty headache in the medium term. And now that these schemes have been going on for so long, they're into the headache portion. the sugar rush portion more or less accounts for all GDP growth since 2013. Now that takes a bit of digestion. So the only increase in EU GDP since they had the euro sovereign debt crisis is attributable to them borrowing mainly at EU level, spending at member state level. The spending increases member state GDP, but the debt does not increase member state indebtedness because it's done in the shadows. It's done at the EU level. It's a very clever trick. GDP growth, yes, that comes about because of spending, but the debt that enabled the spending is invisible. It's kept out of the books.
But it's
And
still
now
there. I mean, as you say, it's kept out of the books, but the debt is still there.
yes, it's still there. It hits EU member states increasingly as either higher taxes that they have to pay to government or particularly increased service charges, usage charges for energy, toll bridges, toll motorways, whatever it is that's been built. The service charge, the usage charge, reduces disposable income or income available to spend, income available to invest. So inevitably, that sucks large amounts of money out of the productive economy into this other side of the economy, which is state directed.
And who are they borrowing from? And are they borrowing from themselves? Because I am hearing about the European Central Bank having to bail out the EU and the EU bailing out the European Central Bank. There's some weird stuff that's been going on.
Yeah, no, it's not really. It's mainly from institutional investors, global investors. So for the coronavirus recovery fund is all borrowed by the European Union, the entity that is now a real legal person. It can borrow. It's borrowing 750 billion in total, but the debt repayment, in part, that's given out as loans. And then if the borrower is real, can pay, does pay, then that flows through. But more than half of the amount was given out as grants. So somehow or other, they've got to conjure up that money from the member states into the EU entity in order to pay the investors. InvestEU, that doesn't flow through either the EU or the member states. That is institutional investor money lent to what look on the face of it private sector companies. But the loan is entirely dependent upon the public sector. It's just like PFI. So a hospital is built or half built in Edinburgh by a private company. The Scottish National Health Service has to pay for it. And those payments go to pay the debts that the private company's taken on. The money flows through from the public sector to the private sector and to then institutional investors. So, and when Rachel Reeves says she wants to get a lot more investment money in from pension funds, this is the kind of scheme she wants to see really being boosted. Maybe not hospitals and schools this time around, but infrastructure of some kind, but particularly for net zero. So they're just going to take us exactly where the EU has gone. And we'll see the stagnation probably 5-6 years in the future, where the EU is seeing it now. But it's all institutional money, and it's all because of the idea that the public sector stands behind all these debts. And if the Italian public sector can't pay, or the Spanish, then the Germans will.
And so far,
That's the whole idea.
the Germans haven't they? I mean, essentially, Germany has been the bank of last resort, lender of last resort for the EU up until now.
Well, I think it's in two ways. Firstly, it's by far the biggest member state that pays in. We were number two. We were the second biggest payer in, rather net payer in, given everybody's supposed to pay in, but then a lot of people take out. But we took out nothing like as much as we put in. And Germany put in even more. This is into the EU budget. But when it comes to all these schemes like InvestEU or the European Investment Bank or the European Stability Mechanism that bailed out Cyprus, Greece, and partially Spain, but mainly it was Cyprus and Greece, the mainstay of the backing of the European Stability Mechanism is Germany and the European Financial Stability Facility. And then when it comes to the EU, because of the legal structure, all of its debts can be tracked back onto Germany. Yes, because the liability structure is called joint and several, or last man standing. If the other 26 member states fail to pay, number 27, Germany, has to pay the lot. That's,
If I were a German taxpayer, I would be very unhappy about that
well, you
situation.
should be. And that's why the majority of them, or a certain number, millions, voted CDU, CSU, or AFD. The, all those three parties, remember, the Bavarian Conservatives are a separate party. All the voters who voted for those three parties voted for the German debt brake not to be released. Those were the manifestos of three parties that said, we're not going to just borrow and blaze away loads of money just to please whoever, other member states, the EU, whatever. No, the debt brake is there to protect our ability to fund our own public services. But then after the election, suddenly the CDU and now the CSU has followed, said, oh no, we didn't mean that at all. The debt brake will be released because we need to look after European security and blah, blah. All the arguments made by the opposition, the SPD, during the manifesto, during the election, why the debt brake ought to be released. So this is a big democratic problem.
What do investors do in response to all of this information? Just keep out of European stocks?
I think it's very difficult because how do you explain, for example, an individual investment manager going to their board of directors or whoever they report to, oh, everybody else is doing this, but we've decided to do that. Well, wait a minute. In the past, we've tried to achieve 1% more than others, or, this a little bit, but it's always benchmarked on what everybody else is doing. But to break ranks and then behave completely differently from everybody else, it's very, very difficult, isn't it? And you never know, I think, in European markets, what's really happening. What are the European central bankers really doing at the moment regarding the debts of France, for example? Because the European Central Bank itself doesn't buy. It's not a buyer or a seller of bonds in any quantity. It gets the individual national central banks to do the business for them. So things become less clear, things go under the radar. Is the market, I mean, to my mind, the bond market in euros is a false market. The credit risk on these bonds is far higher than the ratings imply. The backing behind the currency is much weaker. It really all does come down to Germany, because the other big member states, which is France, Italy, and Spain, Italy's triple B plus or something of that order. Spain is single A. France has been downgraded twice now to double A minus, and in my view, even that's generous. Germany is it's certainly the last big man standing. If it isn't the last man standing, it's the last big man standing. You want better ratings, yeah, triple A, Sweden, Denmark, Luxembourg, the Netherlands, marvelous. Combined GDP about the size of Greater Manchester, not big enough. Ireland, double A, are you serious? When it was in default 10 years ago, 10 or 15 years ago, it's not serious. These Borrowers are all overrated. And then the ratings of the European institutions are simply a reflection of the member state ratings. It's all, I wouldn't say it was a house, it's not a house of cards, but it's a kind of mirror. I have a great rating because you've got a great rating, and oh, and they're rated well because we back them. But when one starts to lose its rating, the others come down with it. Um, so then you've got nevertheless, the idea now is that interest rates should come down. Why should they? Governments are in deficit and over indebted anyway. They should go up. But more likely, the global central banks will make interest rates come down. How are they doing that? By intervening one way or the other. So you're dealing in a false market anyway. If you're happy to live in a false market, do what you've always done. That would be my advice. But it is still a false market.
Good point, Bob. Thank you. It's fascinating to talk to you, Bob. I think we should meet up again in 6 months' time and just see how the economy, the UK and the EU economies have done in that time. Let's see what,
Great.
which elements, if any, have
Yeah.
actually come true that you've mentioned. That'll be fascinating to see. That was Bob Lyddon, a management consultant specializing in banking and financial affairs, talking about the EU and the UK. So, if you've enjoyed this, tell all your friends. As I say, follow us, subscribe, and do comment because we do look at the comments and we do reply. This is the Money Magpie Invest podcast. Come and join us next week. We're doing this every week, all about how to invest and how to find out more about the areas that you're thinking about investing in. We take an opposing view, usually, to the accepted narrative. So we are the Mavericks. And if you're a Maverick too, come and subscribe to us. See you next week.